Ladies and gentlemen, good day and welcome to Baazar Style Retail Limited Q4 and FY'25 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Suyash Samant from Stellar IR Advisors. Thank you, and over to you, Mr. Samant.
Thank you. Good evening, everyone, and thank you for joining us today. I have with us today the senior management team of Baazar Style Retail Limited, Mr. Shreyans Surana, Managing Director, and Mr. Nitin Singhania, Chief Financial Officer, who will represent Baazar Style Retail Limited on the call. The management will be sharing operating and financial highlights for the quarter and year ended March 31, 2025, followed by a question and answer session. Please note, this call may contain some of the forward-looking statements which are completely based upon the company beliefs, opinions and expectations as of today. These statements are not a guarantee of the company's future performance and involve unforeseen risks and uncertainties. The company also undertakes no obligation to update any forward-looking statements to reflect developments that occur after a statement is made. I now hand over the conference to Mr. Shreyans Surana. Thank you, and over to you, sir.
Good evening, everyone. Welcome to our Q4 and FY'25 earnings calls. Our presentation has been uploaded on the stock exchange and the company's website, and I hope you had a chance to go through it. At the outset, let me highlight that the past fiscal, that is FY'25, has been a remarkable year in the growth journey of our company, with the successful listing of the company equity share in September 2024, highest ever store addition of 52 stores versus initial expectation of 35 to 40 stores, to make it to a total of 214 stores, spanning a total area of 19.21 lakh square feet as on 31st March 2025. Crossing 1,000 crore mark in revenue by posting a 38% year-on-year growth to highest ever revenue of 1,344 crore, surpassing our revised growth guidance of 30% for FY'25, and a robust SSG of 13%, which stood above our expectation. The performance is a result of our team's well thought out and implement business strategy, comprising of our focus on offering value fashion in eastern region of India, which offers huge growth potential on account of being under-penetrated, rapid shift from unorganized to the organized. Secondly, our comprehensive product offering across categories, providing a one-stop family experience. Third, our cluster-based approach, which enables improved operational efficiencies and enhanced brand visibility, help us to have a better site selection, better understanding about the catchment, helping in faster achievement of economies of scale. Fourth, our focus on growing private label share. Speaking of which, I am pleased to announce that our portfolio of 10 private label contributes 45% of our total revenue, that is 600 crores in FY'25, which forms a robust CAGR of 64% over the past 3 years. Of this, almost 200 crores were contributed by one of our brands, Square Up, and the other two labels, Miss 19 and Avaya, are close to 100 crore mark. Going ahead, we aim to remain steadfast on our growth strategy and look forward to a continued trajectory. In the current fiscal, we target to add 40 to 50 new stores in core and focus states, and SSG of around 7 to 8%, which is considered healthy in any retail business, and a revenue growth of 20 to 25%. Now coming to the profitability. Before we delve into the numbers, let me inform you that while we report our performance in accordance with Indian accounting standards, we believe that the pre-Ind AS views offers a clearer and more accurate reflection of our underlying expense and thereby profitability. Since Ind AS requires a creation of ROU asset when leasing an underlying asset, the treatment of lease rental and other related expenses are recorded below EBITDA in the P&L, as against recording it as other expenses above EBITDA under pre-Ind AS. This difference in treatment of lease rental expenses leads to a significant gap between the reported Ind AS and pre-Ind AS figures, specifically from a PBT, cash flow and tax perspective. For example, our reported Ind AS PBT in FY'25 stood at 29.6 crores, while pre-Ind AS PBT stood at 52.4 crore. Therefore, we suggest looking at pre-Ind AS numbers for better understanding of business performance. I am happy to report that on pre-Ind AS basis, EBITDA for FY'25 stood at 94.4 crores and including other income, it stands at 97 crores, marking a strong 31% year-on-year growth and meeting our guidance of 7 to 8%. Similarly, PBT grew at a robust 33% year-on-year to 52.4 crore in FY'25. The profit after tax grew 7% year-on-year to 31.7 crore after exceptional losses. Adjusted PAT stands at 39.75 crore, which grew by 35% over FY'24. Please note that this growth is despite us being in an accelerated growth phase requiring front-loaded expenses at store as well as corporate level. Considering the future growth aspect, we have increased our office space, doubled our warehouse capacity and increased the manpower at back-end operation, procurement, technology level and supply chain. Our results reinforce our position as a growth-oriented company committed to driving sustainable and healthy EBITDA expansion. Now coming to Q4 FY'25, revenue grew 55% year-on-year to 345 crore. The SSG saw a growth of 20% in Q4 FY'25, mainly due to preponement of Eid in Q4 FY'25 by almost 11 days, as mentioned on the last call too. Last year, Eid was in the month of April, on 10th April, and therefore its benefits was accrued in Q1. However, this year the positive impact of Eid festival sales have been captured early on in Q4 FY'25 itself. As a significant portion of our L2S stores are located in the states of Bengal, Assam and Tripura, where sales are influenced by Eid season, the SSG in this region was positively impacted in Q4 FY'25. Consequently, the upcoming Q1 FY'26 will be on a high base year-on-year as well as quarter-on-quarter and should be assessed accordingly. While local festivals and events may cause seasonal variance in quarterly performance, they tend to normalize over the full fiscal year, where our financial performance consistently reflects the strength of our business model. We therefore urge you to analyze the company's performance on a trailing 12-month or a full year basis. The gross profit in Q4 FY'25 grew 59% year-on-year to 114 crore and EBITDA on pre-Ind AS basis grew 139% year-on-year to 12 crore. The pre-Ind AS PAT improved year-on-year from loss of 3.606 crore to a profit of 3 lakhs. In terms of key operational metrics, sale per square feet stood at 679 per month in Q4 FY'25 versus 19% up year-on-year, 721 in FY'25, up 12% year-on-year. The total number of bills stood at 3.7 million in Q4 FY'25 and 14.4 million in FY'25, the highest level ever recorded. The average transaction value stood at 995 in Q4 FY'25 and rupees 997 in FY'25. Private label contribution was at 47% in Q4 FY'25 versus 42% in Q4 FY'24 and 45% in FY'25 versus 38% in FY'24. Our inventory per square feet reduced by 239 compared to last year from rupees 2954 per square feet in the previous year to 715 per square feet in FY'25. Lastly, as highlighted earlier, the shift towards organized retail chain is gaining momentum, serving as a significant tailwind for our business. This evolving consumer preference marked by growing brand consciousness and a demand for value-driven pricing continues to align perfectly with our core proposition. With the scale that we have achieved at 1,344 crore of revenue size, backed by healthy share of private labels and our successful cluster-based approach, we believe that we are well placed and ready for the next leg of growth. We remain focused on accelerating our store expansion by deepening our presence in core markets and stabilizing new clusters in key focus regions. With a clear strategy in place, we are confident in our ability to create long-term value and are excited about the strong result we aim to deliver in the upcoming quarters. With that, I would like to conclude my opening remarks and request the moderator to open the floor for questions. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question comes from the line of Pavik Narang with Bastion Research. Please go ahead.
Hi, am I audible?
Yeah, you're audible.
Yeah, hello. Thanks for taking my question. I just had a few quick ones. First, on the private label front, I believe there were initial efforts to enter into the e-commerce or commerce channels. So how's that initiative going?
In terms of private label, as I've mentioned in the last call also, regarding the e-commerce, our focus is mainly on the offline business. But yeah, on the e-commerce side, we are delving into two strategies. One is on the omni-channel account, which is a store from store the deliveries to the residence or the office of the consumer, which is going very well. This year we have registered almost 2.5 crores of revenue around that. And the second was to launch private labels on quick commerce platforms like Blinkit, which we started 2 months back, and it is also going well. We are not displaying all the products that we have in our range of Style Bazaar, but whatever we think is suitable for the quick commerce platform, we are just building that assortment on the quick commerce platforms.
Okay, so going forward, is it expected to become a substantial part of our revenue?
No, I don't think. I think e-commerce or quick commerce will always be a channel for us. And in next 3 years, I see around 2 to 3% of the total revenue coming from all the platforms, including omni-channel, quick commerce, and e-commerce.
Okay. And secondly, could you provide an update on the fire insurance payment that we were expected to receive in this quarter, or maybe any recent developments on the GST order that we have received previously?
So on the insurance side, we acknowledge that the amount is substantial and recognize the significance to the business. But please be assured that we are actively and consistently following up with the insurance company to expedite the processing of our claim. However, at this stage, it is challenging to provide a definitive timeline for the resolution. We remain optimistic about our outcome. We have submitted all the requisite documentation in support of our claim, and we believe it is compliant with the terms of the policy. We will continue to keep you informed of any material development as they arise. We are just awaiting their revert on the entire thing.
Yeah.
And regarding GST,
GST order? Yes.
Yeah, and in February we have received the GST order from the Additional Commissioner, Kolkata North. The order was in reference to a showcase notice covering the period from March 19 to May 19, with a total demand of 10.66 crores, comprising 97.23 in tax and 9.69 crores in penalties. We have filed a writ petition against the order in the Honorable Court of Kolkata.
Okay, and lastly, a bookkeeping clarification. Could you just share the SSSG and ATV for Q4 FY'24?
SSG was 20.4% for Q4, and for the entire year it was 12.69, 13%, and ASP is 304 for this financial year.
No, I meant for Q4 last year.
Last year
Q4 ASP was 309. This year Q4 FY'25 ASP is 312.
And SSSG?
SSG for last year
SSG for last year was 26.6 for the quarter and 9.5 for the financial year.
Okay, got it. Thank you.
Thank you. Next question comes from the line of Palash Kawale with Nuvama Wealth. Please go ahead.
Yes, sir. Thank you for the opportunity. Hope I'm audible.
Yeah, you're audible.
So, sir, my first question is, what was your inventory per square feet for the whole year?
Inventory per square feet is 2715 for the whole year.
4715. And how did you see it going forward?
So from last 2715,
okay,
2,715 rupees, which last year was 2,954 rupees. And going forward also we are seeing, because we are in a Eastern India focused business where there is a lot of fluctuation every quarter in terms of sale. So always there will be a inventory fluctuation going with every quarter. But every year, if you see for almost for the last 2 years, we are reducing our inventory by almost 200 rupees. In December quarter also, we reduced it by 200 rupees. In March also, we have reduced it by 200 rupees. And with all the technological advancements that are taking place in the organization, we are expecting this momentum to continue for this year also.
Sir, how is SAP implementation going on? When can we expect it to be operational?
So I will just tell you about the entire technological advancement, including the SAP. So we have planned to invest around 20 to 25 crores in technological advancement this year. And the key advancement will be integration of SAP HANA Retail, which we have already started. It may take around 9 to 12 months. So maybe SAP will go live maybe in the calendar year 2026, maybe in the last quarter or maybe in the next first quarter of the next financial year. Advancement, the integration of SAP HANA Retail is majorly for enhancing the efficiency, reducing the manual process and the real-time data-driven decision. We are also deploying Inforce system for warehouse management to bring more transparency and accuracy across the supply chain. I think these are the two factors, and apart from that, we are also working on ARS and inventory management tool, which will further reduce our inventory per square feet in the stores.
Okay. And sir, for account keeping purposes, what can be a post-Ind AS profit margin for you next year on a growth of 20 to 25%, say? Because there is a huge difference between pre and post-Ind AS. So we just want to clarify what can be the PAT margin on post-Ind AS, on Ind AS basis.
So as you rightly said, that there's a huge gap between the pre-Ind AS and Ind AS, and I think almost for us it's almost around 45% on the PBT levels. And going forward, we expect on the PAT side, on pre-Ind AS 3 to 4% as a guidance for the PAT for the next coming year, and 2 to 3% will be the guidance for the Ind AS numbers at the PAT side.
So yeah, 2 to 3% is for FY'26 and 27 would be a good assumption to make on Ind AS,
yes,
right?
Yes, and 3 to 4 will be on the pre-Ind AS basis.
Yeah. Okay. And sir, you have already added 9 stores. So, and you're guiding for 40 to 50 stores. So, is this safe to assume that you are keeping the guidance conservative and you might be going beyond the guidance?
So whenever we start a financial year, now we take a target that we can achieve, and then we focus to beat that target. That is always the strive that company strives for. But as of now, yeah, the guidance would be 40 to 50 stores only, and the target revenue guidance would be around 20 to 25% only.
Okay. And sir, how is the competition going on in the new area that you are entering? Are you able to gain the market share, take the market share away from the incumbents in that area?
So I will not say whether we are able to take that, but the SSG growth for the focus states looks very good and promising. Whether if the average SSG for the entire company is 12.7%, whereas the SSG for only focus states would be higher than that.
Oh, got it.
So I think we are gaining the traction in the focus states.
Okay, that's really helpful, sir. Yeah, that's it from my side for now. All the best and thank you for the answers. Thank you. Thanks very much.
Thank you.
Thank you. Next question comes from the line of Tanuj with JM Financial. Please go ahead.
Good afternoon, sir. Am I audible?
Yeah, you are audible.
Congrats on the great set of results, sir. So just wanted to know how is the current demand for the month of April and May for us?
See, in terms of current demand, as I said that because of the Eid shift from 10th April to 31st March, so there has been a shift of sales from April to March. But on ground, the May looks good to me as of now. And overall, this year also looks good to me in terms of demand that we see on ground.
Okay, sir. there was some protest in one of our stores which led to the closure of that store also. So, what was that impact in the Q4 business, and how long was that impact? Like, was the store closure for 1 or 2 days, or that was a long closure, and how is the situation now?
So that incident took place in Dulyan in Murshidabad, and that was in Q1. It was on around 12th or 11th April. So one of the stores in Dulyan, Murshidabad district, it suffered a significant damage because of a mob lynching incident, and resulted in an estimated 25 lakhs loss in inventory and 15 lakhs in assets. A joint survey was promptly conducted by our insurance company and the team, and I think we have completed all the necessary formalities, including regulatory compliance and license renewal for operations. The store is expected to reopen in the first week of June.
Awesome. We have repaid around 20 crores of debt in FY'25. Am I right? So, how much do we expect to repay in FY'26 and 7?
So the total debt in our books is 166, out of which bank borrowings is 122. So coming years, it will be around 80 CR in our debt will be 80 CR, and 40 CR will be bill acceptance. 120 CR against the 166 CR will be the total borrowings in our books coming year.
That is our target.
Okay. Okay. Thank you, sir. That's all from my side. Thank you.
Thank you. Next question comes from the line of Arvind Arora with A Square Capital. Please go ahead.
Hello.
Hello.
Yeah. So, could you please repeat your growth guidance? You mentioned 25%, correct? So, can you please give us a breakup of how much you are achieving through SSG and how much we can achieve through new store expansion?
So 20 to 25% will be the oral guidance, and 7 to 8% will be the SSG.
7 to 8, and remaining would be due to new store, correct?
Yeah.
So, last time when we discussed, you mentioned like if the SSG store is like 4.5 to 5%, then the store would be able to absorb the inflationary pressure, correct? So,
Correct.
If we go like for the quarter 4, and if we see like SSG growth in the quarter 4 is like 20%, and then if I see private label sale is also at 47%, correct? But still we are in paid negative in quarter 4. Could you please share the reason why this is so?
So see, historically Q4 is always a dull month for our company, but because in the March it was a Eid and the Holi put together, so March month was very good. But January and February, because of late arrival of winter, led to a huge discount in winters in the month of January. Because we don't want to carry winter stocks for the entire year, so we generally tend to give a huge discount. So the discounts which were supposed to start from maybe 10th or 12th of January, we had to start from the 1st January itself because of the late arrival of winter. As a result, January was I can say the EBITDA killer. While saying that, if you compare our data from last year to this year, from a loss of almost 3.06 crores, we have been able to come to profit of 3 lakhs. And I think in coming years, if the arrival of winter is good and if we don't have to give too much discount in January, we can have a better quarter in Q4 in terms of profitability.
Okay. Could you please quantify the numbers due to the discount loss that we have offered?
See, I cannot quantify the number right now in terms of, but I can just tell you in terms of January, because the discounts is almost 50% on the winter articles. So the discounts and the EBITDA is quite, as a month, it's a loss-making month for us, and because of that, the entire quarter numbers tend to change.
Okay. And moving further, so if we talk about FY'26 guidance, like you are giving a guidance of 20 to 25%, correct? Last time when we discussed for the till quarter 3, you gave the guidance to like from 25 to 30%, and then when we close the revenue, it's 38%, correct? So is it like we are like highly conservative, or our targets, like internal target is very low? I would rather not say conservative. It's like very low. And then we like so that's the like just trying to understand how we like set the target. Or
See, the internally, we often tend to have take a target which may be higher than, but as a company, we decide that, yeah, we have to stick to the numbers that we will be 100% able to achieve. Suppose that there is always I said that everyone works toward higher numbers so that we can generate that higher number. But as a practice, from the not only post IPO, but as a practice, we tend to take numbers on the account while discussing with the entire team, and we take those numbers which are easily achievable, so that the pressure to achieve higher will be there. But again, if we are able to achieve the numbers on which we make our business plan, we will be able to have a higher profitability.
okay, understood. Okay.
Thank you. Next question comes from the line of Tenmay with Bank of India Mutual Funds. Please go ahead.
Yeah. Thank you for the opportunity. Sir, what could be
Sorry, I lost your voice. Can you come again with your question?
How can we? So now can you hear me?
Yeah, now it's audible.
So, sir, my question is that what should be the optimum cost of retailing per square feet we expect in next year, including rent?
So see, there is no optimal cost of retailing because it tends to change from cities to cities. So metro would be having higher cost per square feet. But in our scenario, if I say, so our average for the entire financial year of FY'25 is around 176 rupees per square feet.
So we should expect around 7-8% increase on that?
In terms of considering the inflation cost, yeah, you can consider that.
Okay.
7%.
7%, understood. So, okay, sir. So, if 8% SSSG and 7% increase in cost of retailing, we should expect around 50 bips or 100 bips increase in EBITDA margin pre-index basis for FY'26?
Yeah, mathematically, yes, correct. You are correct. That's why our guidance is also 7 to 8% only for this year for EBITDA. This year we have achieved around 7.2%, including other income, and our guidance is also 7 to 8.
Understood, sir. Sir, if I look at the cash flow statement, there is a increase in financial assets of around 75 crores. Is that due to the security deposits?
Yes, there is two accounts for that. One is the insurance receivables, for which the amount is yet to be received by the insurance company. So 47 crore amounts to that, and remaining 18 to 20 CR is against security deposits which we have given during the year.
So sorry, 47 crore to be received from insurance company, and another what you said?
Security deposits given to landlord for opening the stores during the year was 20 crore approximately.
Understood. Okay. So if I look at the cash flow statement, sir, if I adjust the rentals also, would it be suffice for the next year? We would be opening 40 to 50 stores with internal accrual, or do we need external borrowings or fundraise?
So we don't need to have the any borrowings further on the account of opening new stores. I think the internal accrual will be sufficient for that once we receive the insurance fund.
Okay, so that could be, so 47 crores would be suffice for the new store additions, and 2.5 crore per store is basically your store addition cost, if I'm not wrong.
2.25 to 2.5.
And that's including inventory.
Inventory and asset put together.
Understood. Okay, sir. Thanks a lot.
Welcome.
Thank you. Next question comes from the line of Devesh Advani with Reliance General Insurance.
Hello. Am I audible?
Yeah, you are audible.
Sir, on EBITDA margin front, the margins have declined by 50 basis points in this for the whole year, right? And also, if you see post-Ind AS figures for profit before tax, it has just increased by 1%, since the top line has increased by 38%. So how should we look at the figures? Should we look at post-Ind AS, pre-Ind AS, the PBT is coming at 33% growth. So how do you look at the figures? And also, going forward, how do you see profit growing in FY'26?
So in terms of more accurate view, I think pre-Ind AS gives you a clear picture. As you rightly said that our EBITDA has reduced by 0.4% from last year, but majorly on the account of corporate overheads that we have built. If you see our margins, EBITDA margins at the store has increased from last year from 12.7 to 13%, but the corporate overhead has increased by 0.7%. As I have already mentioned on the call, on the account of warehouse capacity, doubling our warehouse capacity, doubling our office capacity, and hiring a lot of professionals for the future growth. So that is the decision, and I think in the next coming 2-3 years, we will start getting the operating leverage of all the expenditure that we have built this year. So that I'm coming to the current financial year, if I say. So we are, as I said, our guidance is to grow around 20-25% in revenue, with a pre-Ind AS EBITDA of 7-8%, and with a PAT margin of 3-4% on pre-Ind AS.
Okay. Could you also, if you could also define post-Ind AS figures?
So post-Ind AS again, the revenue remains same, 20-25, whereas EBITDA would be 14-15%, and the PAT will be 2-3%.
Okay. All right. Thank you. Thank you so much.
Thank you.
Thank you. Next question comes from the line of Naitik with NV Alpha Fund. Please go ahead.
Hi, sir. Thanks for taking my question. Sir, I just wanted to understand the cash flow, a little better. And, we when the IPO, we were around 150-160 crores of debt. We raised around 180 crores, during IPO. And now we are again back at 180 crores of debt on a full year basis despite fundraising. Now we have only spent, I understand we have expanded and we have spent 100 crores on the capex, and still we are sitting at the same levels of debt that we were at before IPO. So sir, how are we thinking about this and what is the reason for this, sir?
So in terms of debt, if I say now, so first it's 167 crore of debt lying in the book, out of which 44 crore accounts for the bill discounting. So the actual debt is around 122 crores only. Out of 122 crores, 18 crore is the bank balance, cash and bank that we have in our books. So net debt becomes around 104 crores. Out of 104 crores, 47 crore is lying with the insurance company because we are awaiting the payment from insurance company that way. And the balance payment has been used. I can say the debt has been used for opening stores, because initially our expectation was to open only around 35 stores to 40 stores, but we have opened 53 stores in terms of net addition, and in terms of pure opening stores, we have opened 59 stores. 58 stores. So I think on that account, this debt is there, because we have expedited our growth.
Right, sir. So one more clarification regarding the fire incident. That was, if I remember correct, March or in last year, right? FY'24 March around, and we did not take any. May 20th, and we did not take any provisions for that in the September balance sheet. But come to March again, now we have taken. So any particular reason for not taking any provision back then?
So we have not taken anything in the March. Rather, in September when we published our result, in Q1 itself, we have taken a hit of around 10 crores in the exceptional loss account. That is why after that exceptional loss hit, 47 point something is pending from the insurance company. So the hit was in Q1 itself. and in the current quarter we haven't taken any hit.
Right. No, sir, I meant in terms of balance sheet, you mentioned that 47 crores is lying with the insurance company.
Correct.
Because the debt in September was not as high, right? The debt is higher by 50 crores because the 50 crores we've taken is balanced from the insurance company, which we have taken in March, not in September. So I was just trying to understand any reason we did not take it in September.
Because in 6th of September IPO was there, and out of the fund which we have received from IPO and the sale proceed from Durga Puja, we haven't taken any further loan or increased our loan.
That time, actually that time was the peak season, so the cash flow from the sales was very high during that period. And that time, till that time, the opening number of stores that have opened are also around 20 only for this year. So I think on both accounts, as a result, the debt was not there. But post September, once the season got over and we started opening stores and started paying off the entire 47 crores of inventory that was lying in the store, that credit needs to be paid. So we started paying that off. So gradually we required the debt for the same. We had to use our working capital.
Got it, sir. Got it. So just one more question. Have you seen our rental cost escalating, during this quarter? Because if I compare, our rents have been slightly higher. The difference between pre and post Ind AS, it's.
In terms of rental cost for the entire financial year last year, also FY'24, it was around 9%. 7.3%, sorry, and this year also it is around 7.3%, including corporate overhead and along the store. In terms of per square feet cost, rental cost has increased from 44 rupees to 49, but largely on account of opening more stores in the metro cities.
Got it, sir. That's it from my side. Thank you.
Thank you.
Thank you. Next question comes from the line of Siddharth Jain with Yes Securities. Please go ahead.
Hi, sir. Good evening. So coming back to something on the cash flows only. So one thing, am I audible?
Yeah, you're audible. Loud and clear.
Yeah. So right now we have a cash balance of 18 crores. And if I understood it correct, you said that 47 crores is lying with the insurance company. So is this a deposit that we have given, or is it a receivable that we are expecting because of the insurance claim?
It's just a receivable that we expect.
Receivable, right? Correct. So got it. So the 47 crores, if and when we receive, so that we will be using for the store expansion that we planned.
Correct.
So right now the breakup that you gave of the debt that you currently have, so out of the 104 crores that you just explained, so that if we use this entire 47 crores for the store expansion, so this 104 crores of debt that we have stands as it is. Am I understanding that correct, sir?
Yeah, your understanding is correct.
So, so then, how is there any? Do we have any plans to reduce this? So, like you also mentioned that we plan to reduce the debt further from 166 crores to, out of the 122 crores of bank borrowing, we'll go down to 80 crores. That's around 42 crores. So, how do we plan to do that, sir? Because 40 stores of even if we take a 40 store expansion and 2.5 crores of cost per store, that will equate to around 80 crores of total fund requirement. If out of that 47 crores comes from that insurance claim, balance 40 crores I assume will be from the internal accrual. Upon that, then there will be a 40 crores of debt repayment. So do we anticipate an internal accrual of around 80 to 100 crores next year?
Yes. Technically, you are right.
So one more point to be added, as Janji already said during the opening remarks, that inventory per square feet is getting reduced year on year. So that reduction in inventory will also increase our cash inflow.
So on all the three fronts, the efficiency is driving the cash inflow part. Rather on the capex part, as I also mentioned this, also there will be a capex of around 15 to 20 crores on the technology side also. So even if you consider that, with the reduction in inventory and with the internal accruals that we plan, we will be easily able to achieve the numbers that you just said.
So 15 to 20 crores of technological investment will happen in FY'26. So that I'm hopeful that I wish that we can achieve the 100 crores of internal accruals, because that will be a great significant milestone for us. And there's one more thing on the revenue guidance that you mentioned. So 20-25%, like other participants also mentioned, because when we do the math of 7 to 8% SSG, and so last year also we almost added 30%, like the store count increased by 30%. This year also we are targeting a store count increase of around 20-25%. So are we being conservative in giving the revenue guidance, or are we expecting a slow ramp up on those stores? Because 30% store addition in FY'25, 20-25% store addition in FY'26, and the revenue guidance for FY'26 being 20-25%, which includes the SSG of 7 to 8%. So the balance which we are getting from the new store addition, so out of 250, 260 or 270 stores that we'll end this year with, 100 stores have approximately been added in the last in the last 2 years. So is there the ramp up? Is that the ramp up will be slow, or how is it? Because it's not adding up
Actually, the ramp up is not slow. You have mentioned correctly. So from 162 stores, we have gone to 214 stores, which is a growth of almost more than 30%. But from 214, if we add 40 stores, it's a growth of around 20%. So while growing at the rate of 30% in store count, we have delivered a growth of more than 38%. And this year we are taking guidance to around 20% growth in overall store count, which is if I take 40 as a base for this year's growth. So we are targeting 25%. See, as I said in my previous questions also that I've told, it's not the conservative number that we have taken, and it's not like that the market is slow. It is just that as an internal policy, we have this policy where we create a number on basis of which the entire back-end working happens. So in that we have taken this 25%, but we will strive for growing it further. So historically, whenever we have taken a guidance, so we have always beat our guidance that way. Historically, whether it's internally before IPO also, whenever we had taken a growth, we have achieved higher than that. Rather in last 3 years, CAGR also, if you see, we have grown more than 35% year on year. It's just that it's a new phase. We are entering into the focus states also. So just to be on the correct phase in terms of numbers that we project, we are taking a number on the count of you can say a little bit on a conservative side that way, because we believe that it's better to give the numbers that you say than to not to give that numbers whatever you commit. I think that has been one of the reasons that we are always at this end.
Understood. So when do you start classifying a store into you start taking the store into consideration for SSG? Is it 18 months or how?
It's 18 months.
It's 18 months. So any store which ages above 18 months comes under the SSG tag. Same store, same process.
Correct. Got it. So the stores which have been added in the last 6 months will not be a part of the 7 to 8% of SSG for FY'26.
No.
Okay. So and also the cost that we have incurred in FY'25, like the warehouse like the doubling of the warehouse size and the HO cost. How much? Could you just give us a figure that what was the cost that was incurred for this in FY'25?
So the corporate expense last year was around 48.7 crores, which has increased to 77 crores. That is an increase of around 29 crores put together, out of which 50% of expenditure majorly is on the account of employee costs and on the rental costs.
Okay. So that's a recurring expense that we are anticipating. Out of 77, 50% is a recurring expense. Balance can be a fixed expense.
Yeah, and out of that also, if you see, our HO cost last year was in terms of percentage was 5%, which has increased to 5.74%. Typically, in any retail chain, it revolves around 5% only. So as I was saying, higher we grow in next 2 years, so we will be getting a good operating leverage from the cost side also, apart from the revenue and SSG and the gross margin side.
Got it. So one thing that I noticed, our store sizes have been reducing. Any strategic decision behind that?
So I think it's a mix of both. I will say because we are opening stores in cities also, and in cities you don't tend to get a very big carpet that way. Sometimes you get, sometimes you don't get. So as a result of mix of stores in high streets, we are getting also our lower size stores, I will say typically. And second thing, because when we are going to tier 3, tier 4, and if we are anticipating the revenue will be limited, so we ask the landlords to, if possible, to reduce the size and give it to us, even if they want to charge 2-3 rupees extra on the rental also, but we don't take the fourth floor that way. Now, we try to do that. If this year we have been lucky because in tier 1 and metros and all together, we have been able to implement this strategy. Otherwise, it's a mixed bag. Sometimes we have to take a call also to take the entire building that way, if the site is very good.
Understood, sir. And the last one question, what is our internal target for our in-house brands going forward for FY'26 and FY'27?
So 47% is the number that we are right now at, and 45%, sorry, for the full year, and we expect in the coming 2 years this numbers to get reached to around 65% in the coming two financial years.
And what is the margin difference that we enjoy in this?
So typically it's 1.5%. That is the extra margin that we get around private label. And the target, I will say, is not to increase the price and on that margin. It's more for reverse engineering, which we tend to work with the vendors around for the private label. And as of now, we are just, as I said, one of our private label Square Up has already become 200 crore revenue brand, and two labels Miss 19 and Avaya are close to 100 crore mark. Our target right now is just to that all the consumer comes and buy our private label, they feel the quality of the product, and next time when they come under the umbrella of Style Baazar, they ask for those private labels. So right now we are working for only with 1.5% margin in the private label category.
Understood.
Additional margin.
What is cost of debt that we are paying?
It's around 8%, 8.5% the WCD and 9 to 9.25% on the normal working capital limit.
And bill discounting?
It's on the similar range, depending on the quarter which we are. It's anything between 8.5 to 9.5%.
Perfect. Thank you so much, sir. That was really helpful, sir. Thank you.
Thank you.
Thank you. Next question comes from the line of Divyanshu Mahapal with Dalal and Roacha Stock Broking Private Limited. Please go ahead.
Yeah, thanks for the opportunity, sir. Is it possible to give the number or the SSG for the core state as well as the focus state?
So for the core states, for the full year, core state stands at 11.82% in terms of SSG. And focus is around 20%. Because the number of stores are lower in the focus states in the SSG category. But yeah, it's growing higher than the core. On an put together both the average is 12.69.
Is it right to assume that our more this year or for next 2 to 3 years, our more expansion would be coming in more focused state, or it would be similar range?
I think the range will be, for example, this kind, it will be between 70 to 30. So 70% stores are opening in the core states itself, and 30% would be in the focus states.
Okay, sir. And one last question. If you look at on the demand side, do we see any benefit coming out what the government has given in terms of income tax? So do we see any repercussion or benefit in terms of demand in the tier 2, tier 3, tier 4? Basically tier 3 and tier 4.
So see, in that sense, I will say what we, because right now I think this is just the start of the month, and this is the financial year in which this will take, the effect of this we will be able to see. What I feel is that all the stores in tier 1, specifically in metros and tier 1, will see the benefit of this, because as the disposable income increases in the hands of the middle class consumers, they tend to spend more, majorly on the account of fashion and on the account of food also. Yeah, tier 3, tier 4 typically was always in the bracket which was around 5 to 6 lakhs only. So I don't think a lot of pent-up demand going over there. But yeah, in metro and tier 1, I see the demand coming in.
Okay. Thank you so much, sir, and best of the luck.
Thank you, thank you.
Thank you. A reminder to all the participants, please restrict yourself to 2 questions. Next question comes from the line of Chirag with Keynote Capitals. Please go ahead.
Thank you for the opportunity. First of all, congrats for the great set of numbers, Shreyanshi and team. Secondly, I wanted to know what would be the marketing spends that we are expecting in the coming year. Hello, am I audible?
Yeah, you're audible. Sorry, I lost the connection.
No issues. So my question is regarding what will be the marketing spends going forward as a percentage of revenue?
It will be ranging between 1.5 to 1.7 only. Because as I said that because we are in the cluster-based approach, it allows us to have a higher marketing spend in absolute value. But because we are opening in the core states and in a particular state we are opening more stores, so it also allows us to have a liberty that way. So that typically tends between 1.5 to 1.7%, which has been for more than 5 years now, and that has been the range for the marketing.
That is from me. Thank you so much.
Thank you.
Thank you. Next question comes from the line of Palash Kawale with Nuvama Wealth. Please go ahead.
Thank you, sir, for the opportunity again. Sir, with all the assumptions all the guidance that you give, is it safe to assume that within 2 to 3 years we will be at 10,000 rupees revenue per square feet and pre-Ind AS EBITDA margin between 8 to 10%?
If you take a growth that we are taking right now, I think, you can say that maybe next years, the SSG growth that we have, we will be reaching a mark of 10,000 per square feet. And going on that, the EBITDA range that you said is quite possible to reach that number.
Okay. Is there any plan to enter the neighboring states like MP or Chhattisgarh, since they are adjoining to your core states? So any plan to go there, and why have you experimented with those states, and any guidance or any color on that?
Actually, as a company strategy now, we have always opened stores either in the adjoining area of the states, okay, if the taste is similar to a particular state. So right now the focus is majorly on UP and Jharkhand as a territory. I will say UP, Jharkhand and Bihar. And still there's a lot of stores that can be opened in these areas. As a result, we are not venturing into MP or Chhattisgarh even say. Once we have opened a store in Raigada, which is just adjoining the Odisha border, but not because it was in Chhattisgarh, but it was on Odisha border, and that showroom didn't go well in terms of revenue, so we have also closed that store. So there's nothing to do with the territory. It's just that there's a strategy. We want to go deep in a state. We want to open more stores in a state so that we can achieve economies of scale and profitability in 3 to 4 years only.
Okay, sir. Thank you. That's it from my side. Thank you for the answers.
Thank you.
Thank you. Next question comes from the line of Kushal Goenka with Mangal Keshav Financial Institution. Please go ahead.
Hello. Thank you so much, sir, for the question. My question was on a broader sense. Since the company got listed, there has been some news on fire, then the GST notice. Also on the revenue guidance, in last quarter you had guided for 25 to 30% growth and a like-to-like growth of 8 to 10%. And then after 2 months, you're guiding for 20-25% growth and 7 to 8% same-store sales growth. Also, money regarding the insurance, the CFO, I guess he had clearly mentioned that you will receive the money in Q4. and now you're saying you're not sure. I completely understand, sir, that, many things are not in your control. But, sir, like so many news and, deviation from the guidance also. So just wanted to get a broader sense what exactly are we doing so that this does not happen and we stick to one kind of guidance.
So there are two things to it. First thing, in terms of operational guidance that we have given, and I think we are happy that we are beating that guidance. Maybe we are giving, last quarter I have revised the guidance from 25 to 30%, and we landed at 38%. So it's good for the company that we are getting higher amount of revenue or the margins that we are targeting. Now coming to the question on the fire side, I think on the 6th September when we listed, post that the first quarter one result that was there, the entire this 10 crore of loss was taken as a hit, and the fire thing was explained. What happens in the fire sector is that whatever response that we get from the insurance company, we tend to present that to the market. Yeah, we are expecting this thing, but as I said, right now I don't want to give any date for the same. We have submitted all the documents. We are awaiting their revert, and maybe it may in a month's time, maybe it takes 3 months. But yeah, as all the papers are in line with the thing, and we expect this to get close. Whatever we have understood from the consultants and all things, generally the big insurance claim certainly takes anything between 12 to 18 months. We got this fire around last May, 20th May, and it has been a 1 year time, and I think in next 6 months I hope that everything is settled, because there is no issues in the documents and everything that have been submitted to the insurance company. They are just awaiting for the surveyor's report. Once that goes through, I think we will tend to...
Yes, completely...
Coming to the GST question that you have asked. So see, this GST demand is of May 19 and around, I think, May 19 to June 19, which is in the, I think, normal course of business with the government. Either it's the income tax notice or the GST notice, which is not again in our control, and we are fighting for it. We have filed the writ petition. Even the penalty that has been imposed has been imposed under the section, which technically cannot be imposed us on that section. So we are very hopeful that we have filed for the writ petition. It will come in the favor of company only. So this is the thing. And as per the guidance right now also, I am giving a guidance of around 20 to 25% revenue, and I hope that I am able to deliver higher than that. That's my expectation. But we don't want to have a higher revenue guidance and then we don't achieve that.
Yes, sir, I completely understand that. My point was just like, we had a Q3 Concall in January. So correct. In that you had mentioned 25 to 30%, and now you're saying 20 to 25%. I just meant to say that, it should be like, it should not keep on changing. Like the insurance money also, I completely understand many things are not in your, like you can't control many things, and it's the government and whatever things are happening. But I need to say that answer which is, unique to all the quarters, I think so that should be preferable. Like, it should not change. I just had that point. And so my next thing was, in last quarter, you had mentioned that for FY'25 also, PAT margins will be around 3 to 4%. Anything on that, sir?
Actually, 3 to 4% on pre-Ind AS, right? So if I take the adjusted PAT, right? So before exceptional loss, so the total profit from 31.78, it will increase to 39.75, which will be 3%. So we meet our guidance if we exclude exceptional losses.
That was also mentioned in the last call. And yeah, in terms of growth revenue target, I think that time generally it's around 20-25% is the number that we give. I think we hope that we will achieve higher than that, only 25%. But yeah, that is the guidance.
Sure. And so this last thing, just wanted to confirm one thing. In the investor presentation that has been sent, I think so the profit and loss consolidated INDS number, it's written in crores, but it will be in millions, I guess, because like the balance sheet is of 17,541 crores, but I guess that will be in millions, but it's written in crores. So just wanted to confirm that.
Yeah, it is an error, typo error. Thanks for
confirming that.
Yeah. Thank you for that.
Thank you. Next question comes from the line of Rahil S. with Crown Capital. Please go ahead.
Hi, sir. Good evening. Can you hear me?
Yeah.
Yeah, hi. In the opening remarks, you mentioned that your key focus has been, the Eastern Indian market which is under-penetrated. So is it still the state over there? Like, is it still under-penetrated and your focus lies there?
Yeah, I think because we are yet to cover a large part of UP, Bihar and Jharkhand in focus states also. And still we have just reached around 30-35 stores in Odisha. It's a big state to cover. So I think from UP to Northeast there are 12 states almost catering to a population of more than 40 crores. I think there's a huge room to open stores in next 3 years also over there. Yeah.
Okay. And did I hear correctly that you plan to reduce your debt this year? So can we expect interest costs to go down, right, for FY'26?
100%. So the thing is that, see, as I said, our majorly the fund utilization has been done on the account of the insurance because we have not received the insurance payment. So that 48 crore amount is something that on which we are paying the interest, but we have not received that amount. So sooner we receive that, better will be I will say the lower will be the interest cost that way.
Mm-hmm. And sorry, my line went bad in the previous answer you gave about the PAT guidance, which was 3 to 4% for FY'25. So can you please explain how was it met, but on the results it's not showing so?
So in pre-Ind AS, right? So the total PAT is 31.8 CR.
After exceptional losses.
After exceptional losses, right? So 10.76 we have taken as an exceptional loss. So if we add back the exceptional loss after tax, so the profit will be 39.75. Adjusted PAT will be 39.75, and that on total income will be 3%.
Okay, so it's just a difference of the exceptional loss which will be. Okay. And lastly, in the last call you had said that your target is to reach 5% PAT margin in the next couple of years. Can we expect the same in FY'27?
We will try to reach in FY'27. That is what our expectation is. Anything between 4 to 5%. So target is around 5% only, but yeah, you take a range of 4 to 5%.
Okay. All right. Thank you and all the best to you.
Thank you.
Thank you. Next question comes from the line of Anuj Kashyap with A3 Capital. Please go ahead.
Hello. Good evening, sir.
Hello.
I want to know what is the break-even for a new store? Break-even period.
So generally, whenever a store opens in a financial year, on an average, all the stores tend to get break-even in the first year itself at the store level EBITDA. On an average. For example, all the stores that have been opened during the financial year of 24-25, in this year itself, it will be higher than the break-even point that way. So it will have a higher. Generally, on the opening first year, it's around 5% of the EBITDA that we achieve on an average. When it gets into the next full year run, it gives me a EBITDA of around 8 to 10%. And on the final run, when it goes into the SSG stage, it gives us a EBITDA of 13 to 15% at store level.
And sir, you said, sir, that you are investing like 20-25 crores on the technology and all that stuff. So, sir, what I wanted to know is, as a company level, what we are planning to do is, like, we will have an app of Baazar style, and that will be linked to a pin code specific store, so that the channel to deliver the product can become omni-channel. So that is our strategy, or what?
So there are 3 things to it. On the tech front, whatever we are doing, we are trying to build the backend very strong so that all the growth that we are looking for the next 3 years, we are able to achieve. So the simple thing, for example, SAP HANA Retail. So SAP is a world-class tool that everyone knows about. Once we are able to implement that, I think it will enhance the efficiency, reduce the manual processes, and will help us in the real-time data-driven decision. Similarly, on the Info, again, it's more on a back-end thing. It will help us to have a better, I will say, it will bring more transparency and accuracy across the supply chain. Okay, and I think both of them put together will help us to have a faster lead time to store of inventory, which will in turn again increase the sales and reduce the cost overall level. So that is the thing. On the omni-channel side, on the e-com side, that is not the I will say as an investment part that we are investing in anything on the omni side that way. What we have done is that there is an omni-channel partner to us, so who has a integration with our main ERP, and as a result, whatever individuals or customer comes into the store, and if they want to have an article which is because of maybe of size issue or maybe of the color issue, but they like it, so they can order it from the store itself. And if in the cluster that where the store operates, if any nearby store has got that article, they through logistics, it gets transferred to their home or their office.
I got it right, sir. So sir, at the customer side level, you have brought the third party into it, and the efficiency side, what we are doing is investing so that the cycle becomes more efficient from store to warehouse. Yes, sir. Thank you. Thank you, sir. Thank you. Best of luck. Thank you.
Thank you.
Thank you. A reminder to all the participants, please restrict yourself to 2 questions. Next question comes to the line from Avik Nara, Bastion Research. Please go ahead.
Hi. Thanks for taking my question again. I just wanted to know, of the 214 stores that we now have, how many would be the mature ones and the rest?
So 139 stores is matured.
139 mature. Okay, got it. Thank you.
Ladies and gentlemen, as there are no further questions, we have reached the end of question and answer session. I would now like to hand the conference over to Mr. Shreyansh Surana for closing comments.
So thank you everyone for making it to our quarterly earning calls for Q4 and FY'25. If there are any further queries, please feel free to reach out to Stellar IR Advisor. Thank you everyone. Have a nice day.
Thank you. On behalf of Baazar Style Retail Limited, that concludes this conference. Thank you for joining us. You may now disconnect your line.